Right now, today, February 23rd, 2026, we are standing at the edge of the most important moment in the silver market in modern financial history. And if you do not understand what is happening inside the Comex vaults right now, you are about to be blindsided by a crisis that every single data point has been screaming about for months. This is not a prediction. This is not a theory. This is math. Cold, unforgiving, relentless math. And the math says that by February 27th, the first notice day for March 2026, Comex silver contracts, this exchange may not be able to deliver the physical silver it has promised to the world. And when that happens, everything changes. Everything. So let's walk through exactly what is happening, why it matters, what the data shows, and most importantly, what you need to do right now to protect yourself because the window is closing fast. Let's start with the numbers that should make every investor stop dead in their tracks. As of February 11th, 2026, Comex registered silver inventory. That means silver that is immediately available, warranted, ready for delivery against a futures contract, collapsed below 100 million ounces for the first time, landing at just 98,138,005 ounces after a single day withdrawal of over 3.2 million ounces from the registered category alone. In one single day, and that same day, the eligible category silver that meets exchange standards but isn't yet marked for delivery lost another 4.7 million ounces. That's nearly 8 million ounces vanishing from Comex vaults in 24 hours. Now hold that number in your mind while I tell you this. The March 2026 Comex silver contract currently carries open interest representing between 425 million and 455 million ounces of theoretical delivery obligation. You heard that right? 425 to 455 million ounces of paper claims sitting on top of less than 100 million ounces of registered physical metal. That is not a market. That is a house of cards built on a foundation of promises that cannot be kept. And here is what makes this moment different from anything we have seen before: the delivery rate. In a normal functioning futures market, the vast majority of contracts roll forward. Traders take cash, not metal. Paper settles against paper, and the physical never actually moves. But something has fundamentally broken in that dynamic. In February 2026, the delivery rate on Comex silver contracts hit 98%. 98% of open interest standing for actual physical delivery. That is not a futures market anymore. That is a physical allocation mechanism. That is people saying, I do not trust this system. I want the metal in my hand, not your promise. And who can blame them? When you look back at what happened in January 2026, traditionally one of the lightest delivery months of the year, Comex received demands for over 49 million ounces of silver. In January, the same month that in prior years averaged between 1 and 7 million ounces of delivery requests, January 2026 came in at 7.27 times the level of January 2024. The acceleration is not subtle. It is a signal so loud you almost cannot hear anything else. Now let's talk about how we got here, because this crisis did not appear overnight. This has been building for 5 consecutive years of structural supply deficits. 5 years in a row where the world consumed more silver than it pulled out of the ground. The deficit for 2022 alone was 238 million ounces, the largest in recorded history at that time, and 2026's projected shortfall is approaching 200 million ounces on top of everything that has already been depleted. Comex registered inventories have fallen by approximately 75% since 2020. London's LBMA vaults have shed roughly 40% of their holdings. Shanghai Futures Exchange inventories fell to decade lows, and in some industrial regions, analysts estimate accessible silver reserves of barely 30 to 45 days of consumption. This is not abundance. This is the end of the inventory buffer that has been papering over the gap between supply and demand for years, and now the buffer is gone. The industrial demand story is what makes this a genuine once-in-a-generation structural crisis rather than just a financial squeeze. Silver is not merely a monetary metal that sits in vaults and waits. Silver is indispensable. It is used in every single solar panel on the planet. It is wired into every electric vehicle. It sits inside every smartphone, every 5G antenna, every AI server chip, every medical device, every satellite. In 2025, industrial demand consumed approximately 60% of total global silver production. The solar sector alone has been on a trajectory that has shocked even the most bullish analysts, and the demand from AI data center infrastructure, semiconductor manufacturing, and solid-state battery development is accelerating on top of that. Stanford University researchers published a study in January 2026 in the journal Nature Materials demonstrating that a nanoscale silver coating just 3 nanometers thick makes solid-state battery electrolyte surfaces 5 times more resistant to damage, positioning silver at the center of the next generation of energy storage technology. This metal is not optional. You cannot replace it easily. You cannot substitute your way out of a silver shortage when the alternative technologies do not exist at scale. The supply side cannot respond to price signals the way a normal commodity can, because roughly 70% of silver is mined as a byproduct of copper, zinc, and lead operations. When silver prices rise, miners cannot simply flip a switch and produce more silver. They have to wait for base metal markets to justify new mine development, and that takes 5 to 10 years minimum. Now, add to all of this what China did on January 1st, 2026. China, the world's largest refiner of silver, implemented new export licensing restrictions that effectively ring-fenced a massive portion of the global refined silver supply for domestic use. Under the new rules, only large state-approved companies with annual production capacity of at least 80 tons can export silver, and only after obtaining special government licenses. This single policy change cut off hundreds of smaller and mid-size exporters who had long been critical swing suppliers to global industrial users. The effect on markets was immediate and brutal. Physical silver in Shanghai began trading at premiums above Western spot prices, in some cases $10–15, even more per ounce above what Comex futures quoted. That divergence is a flashing alarm. When physical metal trades at a massive premium to the paper futures price, it means the market is telling you the paper price is a fiction. It means buyers are so desperate for real deliverable touchable metal that they are willing to pay a completely different price than what the exchange shows on a screen. And this brings us to what happens on February 27, 2026, first notice day for the March contract. That is the day when holders of March futures contracts must declare whether they intend to stand for physical delivery. Based on the current trajectory, if even 20% of March open interest demands physical settlement, Comex would need to deliver approximately 85 to 91 million ounces of silver. But registered inventory is already below 100 million ounces and falling at a rate of 785,000 ounces per day. If that drainage rate continues through February 27th, and there is no data suggesting it will slow, available registered silver could be as low as 85 million ounces on first notice day. That means even a conservative 20% delivery demand exhausts the entire registered inventory. If delivery rates match what we saw in January and February, 50%, 70%, the math becomes catastrophic. We are looking at potential demand for 200 to 300 million ounces against a supply of 85 million. That is not a shortage. That is a structural failure. What does a Comex delivery failure actually mean? Let me be direct with you, because this matters beyond just the silver market. When an exchange cannot fulfill its delivery obligations, it has two options. Option one is to force cash settlement, meaning instead of giving you the silver you are owed, they hand you dollars based on whatever the paper price says. The problem is that in a physical shortage, the dollar value they hand you cannot buy you the physical silver at any realistic price because the physical market and the paper market have already decoupled. You are left holding cash that cannot purchase what you needed. Option 2 is to suspend trading, impose position limits, raise margin requirements so aggressively that traders are forced to liquidate, which is exactly what CME Group has already begun doing by shifting margin requirements to a percentage of notional contract value, meaning that as silver prices rise, your cost to hold a position automatically skyrockets, squeezing leveraged traders out of the market. We already saw a version of this play out when silver hit $121 per ounce in late January 2026 and then experienced one of the most violent single-day crashes in commodity history as margin calls cascaded through the system. That crash was not fundamental reality. That was the paper market defending itself, but you cannot defend a paper market forever against physical reality. Physical reality always wins. And physical reality says this: 5 years of deficits have consumed the buffer, China has restricted its exports, industrial demand is inelastic and growing. Samsung has already gone directly to silver mines in Mexico with exclusive offtake agreements, bypassing exchanges entirely because they know those exchanges cannot be trusted to deliver. Tech giants are securing physical silver through private deals, cutting out Comex and LBMA altogether, which tells you what the smart money already knows. The exchange-based pricing system for silver is in its final days. When the world's largest corporations start going around the system is already broken. They just haven't announced it yet. So what does this mean for you? It means that every day you hold a paper silver product, an ETF that is not fully allocated, a futures position you intend to roll indefinitely, a silver account at a bank that pools unallocated metal, you are holding a claim on metal that may not exist in deliverable form when you need it. The entire premise of the global silver market for decades has been that most participants would never actually ask for the physical metal. That premise is collapsing in real time. More and more investors, institutions, and industrial users are demanding physical delivery, and every one of those deliveries makes the next delivery more difficult and the one after that nearly impossible. This is a positive feedback loop of physical demand meeting structural scarcity, and once it reaches critical velocity, there is no paper intervention that can stop it. The gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, compressed from over 100.1 in early 2025 to approximately 45.1 by early 2026, as silver surged over 147% in a single year. That compression represents one of the fastest and most dramatic monetary revaluations of silver in modern history. And yet the structural case for silver, the deficits, the industrial demand, the inventory collapse, the Comex delivery crisis has not been fully priced in. Analysts at major institutions including Bank of America, ING, and Saxo Bank had 2026 consensus forecasts in the $55 to $70 range. Those forecasts failed before January was even over. Silver broke $100. It broke $112. The Sprott Physical Silver Trust doubled its equity program to $2 billion to purchase physical bullion, which at current prices represents roughly 18 million ounces, approximately 16% of all remaining Comex registered inventory being pulled out of the available pool by a single institutional buyer. And Sprott does not buy paper. Sprott buys the real thing and takes it off the market permanently. This is the moment where the paper game ends and the physical reality begins to price itself. The math is unambiguous. The trend is undeniable. The February 27th first notice day is not just another date on the calendar. It is the moment when the market's impossible arithmetic has to confront itself. 425 million ounces of contractual obligation, less than 100 million ounces of registered physical silver, a drainage rate of 785,000 ounces per day, a delivery rate of 98% in February, January deliveries running more than 7 times the prior year level, China's supply no longer freely available to the West, industrial demand that cannot be turned off, miners who cannot respond to price with increased production on any meaningful timeline. Every single one of these factors is pointing in the same direction, and they are all pointing there at the same time in the same month, converging on the same date. What comes next will define the silver market for a generation. The people who understood this before February 27th will look back and know they were standing at the right place at the right moment in history. The people who waited for mainstream media to tell them what was happening will wish they had looked at the data themselves when it was still possible to act. The data is here. The math is real. The time is now. Do not wait for the announcement. By the time the announcement comes, the opportunity to act will already be gone.